Hey, Mike. Just going to ask you to unmute yourself. Sorry.
I forgot, after all the preparation, I forgot to unmute myself. I apologize. So let me start over. So thank you for joining us today. Sorry about the technical difficulties, but I am Mike Rosenberg, and I'm joined by my colleague and friend, Joe Lee from First Eagle Investment Management. And we are here today in the short time we have together, 30 minutes, to talk about a real big topic called retirement income. And it's a big topic. Certainly, we're not going to be able to cover everything that is happening in the retirement income space, but we want to cover a lot. And what we really want to do is try and change your perspective and have you think about retirement income in a different way, in a way that we think helps you think about what solving the real problem is all about. So what I'm going to do in a very short period of time is really start off by helping you frame the problem and think about kind of what the situation is that we're in today within the defined contribution plan space. And then Joe's going to take you through and really help you start defining how to solve the problem, dimensionalizing kind of what the problem's all about, and taking you to start thinking about what some of the real solutions are in the marketplace today. So we'll get started. Please feel free to ask questions through the chat box, and we're looking forward to really going through this with you today. So remember this slide. This is really the conventional thinking about retirement, old school thinking, but thinking that probably still abounds in a lot of people's minds today, where risk is measured by equity exposure. And the way that people defined products were to versus through retirement. Do I take you to retirement or I take you through retirement? And most folks focused on the many, many decades of accumulation without necessarily thinking about what happened after that. That was really the conventional way of thinking about it. And in our view, this is not the way you want to think about it anymore. Things have changed, and it's very much an understanding that the world's changed, right? We no longer think about the retirement journey as just this accumulation phase. We think about it as this 70-year journey of accumulating and transitioning as well as distributing assets. Although, again, as I said, the problems that we think about are mostly about accumulation. Along with that, demographics have totally changed. The world's getting older, and it's not going to change. The world's going to continue to get older. And we've got some examples of that. The pension systems have changed. Many of us, most of us, like our parents and our parents' parents, relied on pension systems where there was a guaranteed stream of lifetime income. That's certainly not prevalent in today's marketplace. And we, along with all the folks in the future, are going to rely upon DC schemes to get us through retirement. The capital markets have certainly changed. 11 years, we're in a bull market. There's volatility today. Interest rates are very, very low, probably low as they've ever been. So we've got a capital markets environment that's very much changed. And the distribution phase, as we've thought about it, as we've started to really get into it, it's very different than the accumulation phase. It is not a one-size-fits-all marketplace. And the real impetus is the Secure Act. The Secure Act passed at the end of 2019, and it gave us that pause. It gave us that opportunity to reflect and to start really thinking about all the things that we need to do to change our perspective on the retirement landscape. I know a lot's happened in 2020 to take our eye off of the Secure Act, but I think 2020 is coming to an end, and I think we're in this new normal, and we need to really start thinking about what to do in 2021. Let's just put some perspective around this. As I said, frame it. Joe, if you change the slide. So plan demographics are destiny, right? The world is getting older, and the assets that are in plans are controlled by the aging. Over 60% of plan assets are controlled by those 50 and older. Not only that, but Joe, if you change the slide, the world population of those 65 and older is set to double by 2060. And those folks that are in the plans are going to continue to work, right? So we've got an aging demographic that's going to continue to grow, and those people that are aged and will continue to get older are going to continue to work. And the thing that we all know also, if you change the slide, is that these folks are reliant upon the DC plan to generate income. We can't rely on old pension schemes. The vast majority of population today is not covered by DB plans, and so they're only covered by DC, and that's going to be their sole source of retirement income. So it's really, really important that they rely on the DC plan. So while those facts may be not new to you, the change is here. And the plans that you manage, the participants that we serve, are expecting the industry to evolve and incorporate these tectonic shifts into not only the plan design, but the investment products that we use to implement our retirement savings. So if you change the slide, let's think about how plan sponsors have reacted to what we've seen. There certainly is high awareness, right? 90%, and these numbers are dramatically different from even 5 years ago, but 90% of plan sponsors believe that it's acceptable to hold assets and retain assets within the plan. 75% of that 90% believe that they prefer to retain those assets. And 64% believe it's a priority to implement retirement income solutions in order to solve the problem. So plan sponsors clearly recognize that that's an issue. But what have plan sponsors done to take it to make the changes to react to this? Well, what's actually been done is very little, right? I think plan sponsors remain confused as to what to do. And it's confused based upon this survey that shows that the things that they've implemented, that they believe are calling retirement income solutions, are really things that are more plan designish. So for example, the biggest thing that plan sponsors have done is they've implemented and allowing systematic withdrawals. The next biggest thing that they've done is they've added education and retirement income tools to help understand the process. So while those things are very important, they're clearly not retirement income solutions. They're just things that help us recognize what the problem is. So plan sponsors are still confused on what to do and what to do next. So Joe, if you change the slide, what's not confusing is what retirees and pre-retirees say they want, right? There is a confirmation in lots of studies out there that say what pre-retirees and what retirees want to do with their money. Both groups want really the same thing with very little difference. What they want to do is they want to continue to grow their assets. They want to maintain their principal, and they want to spend the income that's generated from their portfolio to support their life, to support their lifestyle in retirement. Very different, as we'll talk later on about how you think about the components of return and how you think about retirement income in this solution. And Joe, if you change the slide one more time, the other thing that they're very clear about is that they want to keep the money in the 401k plan. They no longer say, I need to transfer this to an IRA. And I think that's the beauty of what we want to talk about for the rest of our presentation is, and what we've titled our presentation is Water from a Stone. With all the things that have changed, with the capital markets where they are today, with the demographics where they are, with the design of plans and the desire for people to keep their money in the plan and use the plan to generate retirement income, we need to think about this very, very differently. And so with the majority of time that we have left, we're going to take you through kind of what this means. And so I'm going to turn it over to Joe to go through that.
Thanks, Mike. So now, as Mike said, we know what retirees say they want. Now let's take a look at what they're actually doing. And to do that, we're going to look at the activity in IRA accounts. As you can see here, from end of 2013 through 2018, you can see what happened in IRAs. The largest increase in assets came from rollovers. So what retirees are actually doing is they're saying that the 401k plan doesn't give me what I want. 91% of the money that came out of 401k plans over that 5-year time period rolled into the IRA. They then contributed another $92 billion in addition to $2.1 trillion from contributions. So it's really not a contribution vehicle, it's a rollover vehicle. And so as you can see, 96% of the contributions into the plan came from that rollover. The other thing to look at is the 1.05 trillion in market appreciation. So what that works out to be is a 2.96% average annual return, 2.96%. That's 51% of what a 60-40 portfolio returned over that same time period. So if you're looking at just total returns, it kind of tells you that they may not have been able to reach their goals. So you really need to look at it and say, okay, well, what are they taking out? And did they do what they wanted to do, which was spend earnings and preserve their capital. So here's the other half of the equation, right? What they told us they wanted to do and what they are actually doing. They took out $1.592 trillion in assets over that 5-year time period. That's a 4.78% average distribution rate. So we all know the 4% rule. It looks like what retirees are looking to do is take out something like 4% a year and increase that at the rate of inflation. That's interesting because if you look at the components of the return, and this is something we're going to talk a lot about, is analyzing the components of things rather than the total, is the components of that distribution were broken out into what they said. 1.05 trillion in market appreciation, so their earnings were taken out and spent. But in addition to that, they had to dip into their capital. And they took out another $541 billion in their capital. So to meet their needs, if you think of it this way, 34% of their need was met through return of capital. The other 66% of their need was met through their earnings. So they didn't quite do what they wanted to do. They certainly, I think, tried their best, but they, again, in a low interest rate environment, they weren't able to just work off of their earnings. The other thing, though, to consider is market appreciation is broken out into a couple of different components as well. And we're going to dig into that. That's really where the new perspective that we think we need to think about, a fresh perspective, comes from, is thinking about what actually the components of the total return are, rather than thinking about the gross average annual return number. And so that's what we want to do here. First Eagle Retirement Investment Solutions. We want to help you hopefully diagnose the problem with a fresh perspective. And that's what we want to share with you over the remaining couple of minutes. So you heard from Mike about what plan sponsors are thinking and what they're saying, and we heard what plan participants are thinking and saying. So here's another constituency we want to hear from, and that's consultants. So what consultants are telling us is they want to focus on two things. The design preference of a retirement income solution has two major components: income generation and capital preservation. Now, with the key characteristics of a DC plan retirement investment solution in a consultant's mind consists of these things. They all agree that they want a distribution yield of 4% or more, which again, as we said before, would get us really close to satisfying that 4.78% they took out. They also say they prefer 40% or less equity, but it's really not about the equity component. Again, changing the perspective from equity fixed income allocation. What they're really concerned with is drawdown risk, not the equity value. They also want monthly distributions. And what they say is they believe that a retirement income tier would be preferred with single and or multi-asset class solutions in that tier. And also very important to note is they express very limited support for insurance guarantees. So all of these characteristics, if you think about it, can really be gathered, measured, and evaluated. But it requires a bit of a change in the conventional thinking. So you remember this graph that Mike showed you earlier? So we think instead of thinking about it of equity exposure from 100% to zero and from to retirement to through retirement, we think you actually need to think of the phases of retirement as three separate phases that have separate and distinct objectives, separate and distinct key drivers, time horizons, and risks. And we're going to focus on the distribution phase and what those points are. But if you take a quick look at this slide, successful outcomes require a focus on the needs in each phase as being separate items. In the distribution phase, we believe what people desire is an outcome of a monthly income check that allows them to live their life in retirement. They're going to go through a 30, maybe even 40-year time horizon in that phase, or 8 to 10 market cycles. What they want to do is protect their capital, as we said before, generate that monthly income stream. They certainly would like to grow that income at the cost of living if they could. And if they can also grow their capital at the cost of living without dipping into it, it will also give them flexibility and liquidity to meet any unexpected needs. So let's focus on this a little bit more. Here's what we think the new world and the new perspective of a glide path should look like. We should be thinking of it in terms of accumulated wealth as a percentage of what I need. So in the first few years of accumulation, which could last 40 years or so, you think of the blue line as income. Again, focused on income. What portion of my income am I contributing to my plan and helping it grow, so that the burgundy line, my wealth, is growing to the point where I need it for my distribution years, my years in retirement. And at that point, it reverses. Now it's my accumulated wealth that drives my income. So we believe the focus here is to make your wealth last so that you don't run out of money to fund your retirement. And here's how most people think of it: is the income is generated up to a point, but again, the more money I take out of my accumulated wealth, at some point in time, that money could run out, which is what people want to try to avoid. Also, we believe that this problem makes it more difficult to solve because it's also more individualized. So in fact, outcome-focused thinking for retirement income, we think, has 4 distinct or more general paths that you can follow. The first one, like we said, is a little bit closer to what we think today, which is glide path A, that income is generated is not sufficient to meet my needs. So I have to think about supplemental streams of distribution to complement that. That's where capital comes in. As I draw down my capital, it is going to, again, get me closer. I'm just trying to time when my capital runs out. The second glide path, one we think is really what participants tell us they want to do, is they want to spend their earnings on their portfolio, but not spend down their capital, keep their capital constant through retirement. C would be the optimal solution. We mentioned briefly before. My income grows at the rate of inflation through retirement, and my capital grows at the rate of inflation. And then lastly would be option D, which is my income is guaranteed at a set rate, but I should be thinking about whether or not my capital is actually surrendered in order to get the guarantee and what that cost might be. So let's think of it this way: retirement income versus lifetime income versus drawdown and versus managed. And you can add a word to the end of managed accounts, managed payouts, managed drawdown strategies. You take the name that you like. We think that you need to look at these things in components of total return. And we think this is the order that people desire to receive that total return. First would be interest and dividend income. If I have an investment that generates a sufficient level of income, I don't have to worry about complementing it or supplementing it. I just have to make sure that my capital is protected so I keep getting the income I need. If I don't get enough from my income, then realized capital gains are second. So gains that I make that I can then get paid out to me to complement what I'm getting from my income source. Finally is price appreciation and then return of capital. And price appreciation I would think of as unrealized capital gains. And that's where the additional considerations come in. Because you got to think about what's earned, right? Interest and dividend income is earned. It's then distributed, and it is fairly predictable. Capital gains are also earned, distributed, although they're less predictable because they're subject to market volatility. Whereas price appreciation and ultimately return of capital are unearned and unpaid. In order to actually get the money, you have to sell shares that you own. It's less predictable, but even worse in return of capital, what we would call the option of last resort. And that's because when you spend down your capital, versus a return on capital, it's a return of capital. Once you reduce the capital investment, it reduces the interest and dividend generation potential of the portfolio, which means that you start to kill the golden goose. You start taking money out, which means your money's earning at the same rate, less dollars, and the never-ending cycle of drawing down your wealth begins. There are some additional considerations. When you think about income generated, think about the sufficiency, as we mentioned a couple times. Is it sufficient to meet my need? Think about the trade-off between predictability and reliability of a stream of income versus guarantee, and what I might pay for one versus the other. Think about the supplement, right? If I don't have enough income, how do I generate the supplemental income I need? And what's the predictability of that? And then finally, like we said, capital, the option of last resort. If I have to take out capital versus preserving, and the resiliency, right? So volatility is different than return of capital. It might fluctuate, but over a long period of time, if I'm invested in things that do not permanently deplete my capital, then I have the resource to go back to. I have my liquidity and I have my flexibility. So let's look at a couple examples of the different glide paths, right? And put those things into context and into practice, right? So if you think about offering solutions designed to achieve the objective, here are three different things that could exist in a portfolio today. And then the fourth one would be something that could be added to consider, right? The fixed income approach, right? We all have a bond fund, for example, in our 401k lineups. On the right-hand side, the total return approach, like a retirement income fund, or a hybrid approach, which will just differentiate something that's actually designed to generate a growing stream of income. So here, a fixed income approach. And in this example, we use one of the more popular bond funds and 401k lineups today. Think of this as like distribution path A in our outcome-focused glide path analysis. And look at the bottom right. So if I needed $350,000, which we come up with that number with a 4% distribution beginning day one, growing at the rate of inflation since 2012, I would have needed $350,000, would have been income need that would make it sufficient for me to survive. In this example, $205,000 or 59% came from dividend and interest income. $105,000 or 30% came from realized capital gains, and I had to sell another 11% to get of shares in order to get my need. Now, what's interesting about this is it was a declining interest rate environment. So consider the fact that your income was declining over this period. Therefore, your realized capital gains were going up because bonds were appreciating in value and potentially getting called away. And the shares that were sold, because the bond prices went up, were sold at a higher value, potentially than what they were bought at. The problem with that, if you consider it, is what happens in an environment where interest rates start to rise. Your income may go up, but you'll have less money to invest. And again, you've locked in your distribution at a lower rate. So in the past, you got 4% income growing at the rate of inflation, but your overall wealth decreased by 8%. Now, potential way to look at the total return approach or the retirement income fund of a target date series is this is like glide path B. What I got here, the same $350,000, but 50% of that came from dividend and interest income. And that's because they don't really think about distributing income. It's that methodology of equity and fixed income allocation, not necessarily component of return change. 18% came from realized capital gains, and 32% came from the value of shares sold. Again, as Mike said before, in an 11-year bull market. If that were to change, think about what that might do to achieving my objective in retirement. And then here, again, we'll use our own First Eagle Global Income Builder Fund, right? So here you can see, like we said, we achieved the income and our wealth grew by about 8% over that time. But in this example, right, we have a 4% income stream and our wealth grows by twice as much. The interesting part about this is, again, look at the dividend and interest income. It accounted for 80% of my need. Realized capital gains was another 6%. So 86% of what I needed came from what was distributed, which required me only to sell 14% of the shares over that time period. And you'll also notice that at no time over that 7-year period did my capital dip below my $1 million investment. And then finally, with the Secure Act, this is going to become a big discussion for folks is, well, what about guaranteed income? And that, as I said, is like glide path D. Now, this one you're going to have to do a little bit more work on. We looked at this and did some analysis ourselves. We used some calculation through Schwab. Schwab has an annuity calculator, and there's other calculators out there. But here's what we found. If you took that same $1 million and you took it today and you put it into a fixed income annuity, you did it for a person who was age 65, who was married with a spouse who was also 65, taking their first payment, and they invested $1 million. The results we found were that you would get $46,308 a year. But we looked at that from a 20-year period certain fixed annuity. So we did not look at increasing the distribution. So it started at a higher rate, but again, that was fixed, so it wasn't going to grow with inflation. The other thing you find out when you do that is that the minimum payout was $926,160. What that means is if the investor and his spouse were to die on or before the 20th year of payment, the insurance company will guarantee that they or their beneficiaries would receive $926,000. So remember, you put in $1 million. So the question there is, should we be thinking about whether or not that is a return of capital rather than a return on capital? And what could that money have earned had I invested it in the market without the guarantee, which therein comes the trade-off between guarantee and reliability or predictability. So again, if you think about this from the perspective of, think about this from the perspective of the different glide paths in our new perspective, right? There are, these different glide paths that we should consider. And knowing that individuals have differing needs and goals, it actually might be a combination of A through D that would become better outcome-focused thinking, right? Outcome-focused glide paths that might be the best thinking for retirement income. And we think that might be a more prudent way to think of it. So Mike, I'll turn it back to you.
Yeah, so I think, what we're advocating here for is really a retiree tier, and the varied solutions that a retiree tier can offer to help fiduciaries of all types address this real problem that's in the marketplace today. So think about what the DOL, what ERISA asks you to do. Think about all the things that you've done on the accumulation side to set up investment menus that meet the needs of and the objectives of participants. We need to think about that on the reverse side, right? In the decumulation side. So it's certainly not a silver bullet solution, a one size fits all opportunity. There's a lot of opportunities to use varied solutions, a retiree tier that can encourage participants to do what they want to do, which is keep the money in the plan and use this as a distribution vehicle. We covered a lot in a very short period of time. And what we want to make sure that you have is the understanding that what we're advocating for is making plans better. 2020 is probably a year that we had to solve and deal with a lot of problems that were our clients just thinking about operating their business. 2021, we encourage everyone to dig back in, think about the Secure Act, and start to work on this problem and offer solutions to make the plans better. So it could be as simple as starting and adding something, a capital market solution that addresses the needs of the retirement income marketplace within plans. Then you can think about extending that to a complete retiree tier and adding things that, as Joe said, meet those different types of glide path like we've done on the accumulation side. And we know this, that the market will continue to evolve. And as the market evolves, there'll be lots of opportunities to innovate, and there'll be lots of opportunities to continue to add solutions that meet the needs. We think that there's a great place to start, though, which is adding. But before you add, and Joe, if you switch the page, there's really what you need to do is sit down with all of your clients and help them make that assessment. What is the purpose of the plan? What's the purpose of this particular outcome-oriented approach? What do they believe they need to do? And what are the things that they need to do within the plan to continue to make the plan better and address the needs of these participants? So there's a lot of things here. Most important is that you start to think about it. Most important is that you engage your clients in asking questions, and you engage folks like First Eagle in the marketplace to address and bring the conversations to light. So again, thank you for taking the time. There was a few questions. I'm not sure we have a ton of time maybe to answer one. One easy question that we can get was, are the slides that we've gone through going to be available made available? And certainly they are. And if you've got questions, you can email either Joe or me. It's our name, michael.rosenberg@firsteaglefunds.com or joseph.lee@firsteaglefunds.com. Easy, we can send you the slides, or we can certainly get them through the team at Excel. Joe, maybe one question that I'll throw to you, and then again we can forward these out to others and answer their specific questions. But question about, how do you take into consideration longevity risk in the accumulation stage to ensure participants don't run out of money?
Yeah, well, I'm going to go back to the options, right? Obviously, you don't run out of money if you don't dip into your capital. So again, using the outline that we talked about, if you look at investments, not just from a total return perspective, but actually dig deeper into it in terms of what the components of return are. Look at the ability of that portfolio investment, their ability to generate actual income. What is the interest and dividend income portion of the total return? What has been the capital gain profile of that investment over time? Right? Look at that as the portion of total return. That's much more consistent, predictable, and repeatable. And then, of course, you can look, and the closer you get to satisfying the need with that level of income, the less likely you're going to dip into principal, and the further out you start dipping into principal, the longer the money lasts.
Yeah. So I think we'll end it there. Again, there was a few other questions that are very detailed, and we will follow up directly to make sure that those get answered for you. If you've got questions, again, feel free to email us, or we'll work through the Excel team to get the slides out. But thank you so much for taking the time to dial in and listen to us. We appreciate the support, and we're looking forward to helping you build your practice and answer the needs of the retirement income space. So thanks again for your time.